Again, sellers, aka the sellers. Okay? This is the price that the seller wants you to pay for a stock. That's why he's called a seller. Okay? When the demand for shares is less than what's currently available, this creates a downward move, bearish move. So sellers are connected to bears. Buyers, you heard that. When buyers, this is the price that you want to pay for the stock. You're the buyer. Okay? When the demand for shares is greater than what's available, this creates a bullish movement. So buyers are connected to bulls. Bear market, meaning the market is in a downtrend. Bull market, the market is in the uptrend. Breaking out through an identified level of resistance. A catalyst is the way to predict a move in the market because something has happened. Some kind of news, some kind of earnings, FDA approvals, mergers, good news, bad news. Continuation is when a stock is going one way, consolidates or rests, and then continues on that way. The new words for today. Consolidation, we just went over that. That's when the stock price is not moving up or down. And you only want to buy a stock when it's breaking out of a consolidation pattern, whether it's breaking out up or breaking out going to the downside. Day trading, the simple act of buying shares of stock with the intentions of selling them on the same day. Let's skip discretionary trading. We'll come back to that. Let's go to dip. Dip is when a stock is uptrending and has a temporary fall in price, creating a temporary low. We also call this exhaustion moves. Remember this, stocks go up like stairs. So a stock could be uptrending, take a breath, come down. Some people take some profits, some other people join in and might add to their position, and then it goes up, continues where it was going. This is called a dip. Edge, and this is a very key word you all going to have to know, edge. Edge is the higher probability of one outcome over another. Traders trade with edge. What is your edge? When we get to that point, when we start learning patterns, there's one key thing that I learned that I want to pass to you. When someone asks you, how do you trade? You should be able to tell them in an elevator ride to the 3rd floor. If you can't explain how you trade in an elevator ride, you're not trading. You're gambling. So what we trade is an edge. And an edge is one higher probability of an outcome over another. Okay? Float. This is a very important thing you're going to need to know. Float means the number of shares that are available for trading. Okay? That particular stock. A company may have 80 million shares outstanding, but if a lot of those shares are restricted and can't be traded, what's left available to be freely traded is the float. That lets us know how many shares of this stock are available to be traded. When we start looking at more stock charts and we start getting ready to place orders and start going through our process, one of the steps in our process is identifying, is this a low float stock or a high float stock? And we'll cover the importance of that later. In the next class, we will continue with more candlesticks charts. We will also continue with more definitions. We will then, at the end of that class, Saturday, start determining which broker you all want to get with, which account you want to open up, and beginning that process of getting you all familiar with the trading platform. Just to reiterate, I do want everyone to start off paper trading initially just to get yourself familiar with the platform, how to execute, buy, sell, and protect yourself. After that is done, we will immediately go to trading real money, even if it's just 5, 10 share positions, because we need our emotions to be put in check and be tested. Because you can have everything set up correctly, but the difference is, it's like a basketball player. There's a lot of professional basketball players, but when the game is on the line, at the free throw line, can he be counted to hit those 2 buckets then? The difference is emotions. And when you have real money on the line, emotions will change everything you think you know about yourself. What does a low float mean? Generally, it's a stock that has less than 10 million shares available. Stocks with low floats are typically volatile. If a stock has good news, then there are typically only so many shares that can be bought, because typically we're talking about, in this example, only 10 million shares that are available. The smaller the float, the less sellers there are. They're not going to give up their shares of this stock, okay? And the less sellers there are, the more severely the buyers want to be, and they end up stockpiling upon themselves to get in, okay? This stock could also go on very big runs because you have a high demand to get in it, very low shares that are available. The demand is high, the supply is very, very low. You can be a little bit more patient going long on this stock, and definitely be patient shorting. So a low flow stock is a stock that can typically have a burst on some good news. It's a stock that only very few shares are available, but the demand is great. The people ain't giving up their shares. People want to get in, and that stock could skyrocket 20, 30, 50, 100% in a day or even more. FOMO. FOMO, that's how it's pronounced, FOMO. The definition of FOMO is the fear of missing out. The fear of missing out. These are one of the words that will be connected to the psychology of trading. This is what moves people. You could have a plan, you could have all the discipline in the world, but the fear of missing out will make you do something emotionally. The next word is gap up. This means that a stock opens at 9:30 when the market opens higher than it closed at 4 the previous day. Gap down. The stock opens at 9:30 to begin the market open lower than what it closed the previous day. HOD is the next word. HOD, which is abbreviation for high of day. All right. The next one is index. An index is a small basket of larger stocks used to represent the entire market. An example of this might be the S&P 500. Okay? Limit order. A limit order allows you to buy or sell at a particular price. The price you want to buy or sell at. This means you will only get a fill at that order or better that you selected. A limit order guarantees the price that you get, but does not guarantee the fill. A limit order will guarantee that price, but not guarantee that the execution of that fill. Okay? So a market order, you're guaranteed to execute. So if you want to get in the stock, you'll get in it. You want to get out of the stock, you'll get out of it. But at what price depends on what the market is doing. So you have to be very, very careful of that. You can control, okay, where you place an order at. You can control the price or the time. A limit order allows you to control the price with no assurance of a fill. A market order allows you to control the fill, but not a guarantee of the price. 99% of the time, we want to use limit orders, and that's what I use. The next word is liquidity. Liquidity. How many trades were there on the day? How many transactions? The more transactions, the more liquid the stock is. Liquidity is very important because it allows you to get in and get out of a stock. If a stock is illiquid, and let's say you are holding a position, you're sitting on a position of 5,000 shares. The stock is going against you. Have bad news. You wake up, man, you want to get out of it, but it's illiquid. Now you're stuck. You can't get out because there's no one there to buy those shares on the other end. So that's why liquidity is very, very important, okay? Liquidity is characterized by a high level of trading activity. And the higher the liquidity, the easier and quicker it is to execute fills. Illiquid stocks may cause problems entering and exiting positions, which can be especially dangerous in the case of price gaps, as I just spoke upon. If the price were to suddenly blow through a stop loss position in an illiquid market, it's highly probable that that stop would not be triggered, therefore exposing the trader to unexpected and substantial losses. Choosing stocks with high volume and liquidity will provide the trader the flexibility and consistency that you will need to enter and exit positions effortlessly, okay? Thereby ensuring the best possible chance for success. It's illiquid on the way up is going to be even more illiquid on the way down. So liquidity matters. We use frequently. Long. This is the going and buying a stock in anticipation of the stock price rising or going up. So when you say you're going long on a stock, you are anticipating higher prices. Market hours. Pre-market market hours are from 4 a.m. to 9 a.m. The market opens is from 9:30 to 4 p.m. and after hours is from 4 p.m. to 8 p.m. Market makers. Who are market makers? This is very important information. Now, market makers are high volume traders that quote both a buy and a sell price order on a stock or security, in this case a stock, and they profit from the difference. Again, they're high volume traders that are quote a buy and an offer at the same time and profit off of the difference. Every stock needs a buyer and a seller in order to move the exchange. If you want to sell 100 shares of XYZ, it is unlikely that you will immediately find someone who wants to buy the exact number of shares, okay, that you want to sell. This is where the market maker comes in. The market maker will buy those shares every time from you, even if there's no buyer lined up, allowing the market to stay liquid. Market makers account for the speed in which transactions take place. Without market makers, it would take a much longer time for buyers and sellers to be matched with one another. This is what market makers do. They take both sides, they profit off the difference, but they keep the liquidity in the market. Momentum trading. This is a form of trading. Trades that have a sharp increase in volume and price action from support through resistance. Riding the wave up, quickly getting in and out. Intraday based entry and exit. A lot of momentum traders are day traders. They take advantage of a catalyst which has this stock moving. And have you ever heard the old saying, buy low and sell high? Momentum traders buy high and sell higher. Okay? Oversold. You hear that a stock is oversold. What does that mean? Oversold means that the price of a stock has dropped below its true value, resulting in a panic sale. Anytime a stock has dropped below its true value, it results in a panic sale. The next one is red to green. You're going to use the terminology when a stock is making a red to green move. What does that mean? That means the stock on the daily chart goes from being a red candle to a green candle. The stock is changing on the daily chart, began as a red candle and is now turning green. That's the terminology. The stock is making a red to green move. The opposite makes just as much sense. Stock is going green to red. the stock on the daily chart goes from being a green candle to now a red candle. Okay? RSI is called the Relative Strength Index. Okay? Typically, when it's below 30, this is confirmation of a stock being oversold from a panic sale and getting ready to bounce. Because when a stock drops below its true value, as we learned, being oversold, and panics and the price drops to other buyers and bulls, this becomes a very attractive price target. Shorting. We will cover shorting later, but that is very intensive, and I want to make sure that everyone understands how to short a stock. This is how you become a bear. And we know bears go against the bulls, and we will cover that in shorting, but essentially this is what the bears do. Okay? Short interest is the quantity or amount of stock shares that investors have sold but yet to cover. Interest accrues in percentages until these shares are repurchased. The short interest can give you a picture of whether investors are bullish or bearish on this particular stock. So you want to know, what is the short interest on that stock? Okay? How many shares are still out there that have yet to be covered? This is a good indication that soon the bears are going to have to cover their position. And in order for the bears to cover their position, they have to buy, which is the complete opposite of the bulls. The bulls buy low, sell high. The bears sell high, buy low. The next one, short squeeze. We're going to save that for shorting. Once we cover shorting, we'll come back to that. Spread. The spread is the difference between the bid and the ask. Remember, bid is for buyers. That's the price you want to pay. Ask is for sellers. That's the price they're asking for their stock. Spread is the difference between the bid and the ask. The closer the spread is, the easier it is for execution of the orders getting filled. And we'll go ahead and stop there.